Have you heard? Toronto's vacant home tax just tripled to 3%. For anyone holding a high-end property, that's $45,000 gone every year, whether you're making money or not. And here's the kicker. Property values are flatlining, but holding costs keep climbing. Is this the start of a market crash, or the smartest time in a decade to reposition your portfolio? I'm David Clark, a real estate advisor who's been through 2 market cycles. Trust me, this feels familiar. But there's a twist. While Toronto's tightening the screws, savvy investors are moving their money west to Calgary and cashing in. In this video, I'll show you exactly why Calgary is quietly becoming Canada's top-performing market in 2025 and whether it's time for you to make the same move. Stick around, because in the next few minutes, you'll get insider strategies, real data, and a clear plan to protect and grow your wealth this year. And if you think this is just another headline grab, wait until you see the numbers. Take a look at this chart. Toronto versus Calgary. Investor ROI 2023 to 2025. Section 1. Toronto's 2025 reality check. Is the market still worth it? Let's start with the numbers, because they tell a very different story from what most headlines are screaming. In early 2025, the average home price in Toronto is sitting at $1.1 million, according to CMHC. On the surface, that looks stable. But dig a little deeper, and you'll see sales volumes have dropped by 15% year over year. More worrying, the average time on market for luxury properties has doubled since 2023. Take a look at this chart. Average time on market for luxury properties. Toronto, 2023 versus 2025. Now, if you're holding a property that's not producing rental income, especially with the vacant home tax now sitting at 3%, you're bleeding cash. Let's do some quick math. A $1.5 million condo, vacant, will cost you $45,000 a year in taxes alone. And if you add maintenance fees, property taxes, and financing costs, it's not uncommon to see carrying costs approach $70,000 annually. I spoke with Sarah, a client of mine who's been investing in Toronto for over a decade. She bought a $1.8 million penthouse in Yorkville back in 2023, aiming for a luxury flip. By mid-2024, Toronto's new vacancy rules kicked in. Her holding costs skyrocketed, and despite listing the property in early 2025, she's had 0 serious offers after 4 months. Her words, "This isn't a correction, it's a slow grind." And she's not alone. Many high net worth investors are feeling squeezed, but not everyone is prepared to make the tough calls yet. Section 2. Calgary, Canada's unexpected star in 2025. So where's the smart money going? Increasingly, west to Calgary. Let's compare. Calgary's average home price in Q1 2025 is $550,000, according to CREA. That's less than half the average in Toronto. But here's the kicker. Rental demand is booming. Vacancy rates in Calgary's core neighborhoods like Beltline and Mission are hovering at 2.1%, while average monthly rents for a mid-tier 2-bedroom unit have climbed to $2,500. Take a look at this chart. Rental vacancy rates, Calgary versus Toronto, 2025. I recently worked with Michael, an investor from Vancouver who shifted $2 million from Toronto to Calgary in late 2024. He acquired 4 duplexes in Bridgeland for about $500,000 each. After minor renovations, each unit is bringing in $2,800 per month in rent, yielding a net return of over 6%. His take? I spent a decade chasing appreciation in Toronto. Now I'm enjoying real cash flow without the headaches. And that's not just anecdotal. Alberta's no provincial sales tax, lower property taxes, and an investment-friendly regulatory environment are turning Calgary into a cash flow machine. The city's population grew 3.5% year over year, driven by tech expansion and interprovincial migration. And unlike Toronto, there's no vacant home tax looming on the horizon. Section 3. Mortgage rates, how they're shaping investment strategy. Now, let's talk financing. Interest rates have been a wild ride in 2025. In Canada, the 5-year fixed mortgage rate sits between 5.5% and 6%, depending on lender and borrower profile. But here's the opportunity. Calgary's lower purchase prices mean lower leverage risk. In Toronto, a $1.5 million mortgage at 5.8% locks you into monthly payments of over $8,400. In Calgary, a $500,000 mortgage translates to about $2,800 a month. Far easier to manage and with much healthier rental coverage. Greg McBride, chief financial analyst at Bankrate, summed it up perfectly in a recent interview. High rates punish the over-leveraged. Investors who focus on yield and cash flow will come out ahead. Check this out. Monthly mortgage payments, Toronto versus Calgary, 2025, based on 5.8% rate. Section 4. Lessons from global markets. What New York, London, and Sydney teach us. What's happening in Toronto isn't unique. If we look globally, high-tax, high-regulation cities are experiencing similar investor fatigue. Take New York City, for example. Between 2020 and 2024, a combination of mansion taxes and strict rent regulations saw luxury property prices stagnate. Investors started shifting capital to Miami, where lower taxes and stronger rental yields were more attractive. Miami's high-end market saw double-digit growth while New York plateaued. In London, similar patterns are emerging. With the UK government mulling stamp duty reform and tightening landlord regulations, many investors are reallocating their capital to Manchester, a market with a median price of £230,000 and stronger rental yields. Take a look at this chart, luxury property ROI, New York versus Miami, London versus Manchester, 2020 to 2025. And in Australia, Sydney's $1.66 million median house price, combined with stringent foreign buyer restrictions, has made Brisbane the new hotspot. With an average price of $883,000 and yields pushing 5%, high net worth investors are snapping up properties before prices climb further. The takeaway? Markets with friendlier regulations, lower entry costs, and better yields consistently outperform when the economic cycle gets rocky. Section 5. Risks and red flags. What you need to watch. Now, before we crown Calgary as the perfect solution, let's be realistic. Calgary's economic strength depends partly on energy prices. If global oil demand slows, job growth could take a hit. That's why savvy investors aren't going all in. They're diversifying. A common strategy I recommend to my clients: 50% in Calgary, targeting cash flow heavy assets, 30% in U.S. secondary markets, like Harrisburg, Pennsylvania, where median home prices hover at $250,000 with 5 to 7% projected growth, 20% in stable UK markets such as Manchester. Another risk: overheating. Brisbane's recent boom is a cautionary tale. Prices there jumped 10.4% year over year, but if migration slows, rental demand could soften. The same applies to Calgary if inter-provincial migration trends reverse. Take a look at this chart: population growth versus property prices. Brisbane and Calgary, 2020 to 2025. Section 6. Actionable strategies for 2025 investors. So, what's the move if you're watching all this unfold? Here's a playbook I'm recommending to clients this year. Re-evaluate Toronto holdings. If your property isn't generating solid cash flow and you're facing heavy taxes, now's the time to assess its place in your portfolio. Run new projections with 3% vacant home tax factored in. Many are surprised at how thin their margins really are. Pivot to Calgary for cash flow. Focus on duplexes and triplexes in areas like Beltline and Bridgeland, where demand is strong. Lock in 5-year fixed rates while they're still relatively low. Look for distressed opportunities. In Toronto, some owners are getting squeezed and willing to sell at discounts. But if you go this route, ensure the property will cash flow immediately. Don't buy on hope. Diversify across markets. As mentioned, split capital between Canada, US, and UK secondary markets. Hedge against economic downturns by spreading your exposure. Stay nimble. 2025 is not the year to set and forget. Regularly review policy changes, especially in Toronto and Vancouver. A sudden tax shift could make or break your numbers overnight. Section 7. So, where's your money heading in 2025? Let's take a step back and recap what we've uncovered today. Because if you're still watching, you're clearly serious about making the right move in 2025. First, Toronto. It's still a world-class city, no doubt, but for investors, the numbers are tightening. You've got a 3% vacant home tax, high carrying costs, and a slower luxury market. If your property isn't working hard for you, it's time to reassess. Second, Calgary is offering what Toronto can't right now. Affordable entry points, healthy yields, and a business-friendly environment. We're seeing net rental returns upwards of 6%, and the market fundamentals are pointing to continued population and job growth. Third, we've learned from global patterns. Investors in New York, London, and Sydney have already made this pivot, moving away from over-regulated high-cost cities into secondary markets with better cash flow. Calgary could be Canada's version of Miami or Manchester in 2025. And finally, the playbook is clear. Run your numbers, no guessing. Diversify wisely. Don't go all in on any one city. Stay ahead of policy shifts before they hit your returns. Take a look at this chart. It really drives home what we've talked about today. Projected net rental yields, Toronto versus Calgary 2025. Final thoughts. Be proactive, not reactive. I always tell my clients, whether they're in Vancouver, London, or Sydney, it's not the investors who wait that win. It's the ones who move early, with clarity and confidence. You don't need to wait for the next report or another 6 months of what-ifs. The opportunities are here. Calgary's window won't stay open forever. Smart capital is already flowing in. The question is, will you be part of it, or watch it happen from the sidelines? Let's talk strategy. So what's your move? Are you doubling down on Toronto or shifting to markets like Calgary? Maybe you're looking at Brisbane or Manchester. We've covered a lot of ground today. Drop your thoughts in the comments. I read every single one, and I'm always keen to hear how investors like you are navigating 2025. And if this video sparked a few ideas or made you rethink your portfolio, give it a like, hit subscribe, and turn on notifications. Because at EstateScope, we break down the data that keeps high net worth investors ahead of the curve. And trust me, you won't want to miss what's coming next. The next move is crucial. One last thing, 2025 isn't about playing it safe. It's about playing it smart. And in a market where timing is everything, the next 6 months could define your next decade. So stay sharp, stay informed, and I'll see you in the next video.